Doing? So I didn't realize this, but I was just inviting, or like introducing myself and why we're doing this and all that kind of stuff. And then I realized it wasn't the broadcast wasn't on. So now it's on. I'm Tim Bratz. A little backstory. A lot of you guys know me from social media, real estate investing, commercial empire is my thing. I am not a financial advisor. I'm not telling you what to do with your money. I sat in a mastermind last month, and they brought in a financial advisor, investment advisor, to come in and share some information about exactly what I'm going to be talking to you guys about, and the scams and the schemes and the smoke and mirrors of traditional investments, right? Traditional investment advisors, and how the finance industry really dictates and directs all this stuff that common investors don't know about, right? Like I've invested, dedicated my life to personal finance and investing and real estate and all these different things, and wealth generation and legacy wealth. Like that's my whole thing, right? And my jaw just dropped when this guy told us about all this stuff. And so I said, hey, can I share this with some people, right? Like it's important to me. Like I felt an obligation and a duty to go out and share this information with you, with my parents, with my family, with my friends. And so like I invest heavily in apartments. I have most of my holdings and most of my wealth is in apartments and commercial real estate. I also have some money in the market, and I'm moving that around right now because of this information. This is one opinion, right? Like this, you'll find opinions across the spectrum for all sorts of different things. So don't get mad at me. I'm just trying to enlighten you guys and get you guys asking some better questions about your own investments. Ask them to your financial advisor, all that kind of stuff. So I'm gonna run through all this stuff, and then if you guys have questions, just shoot me a message afterwards. 5 key considerations to unlocking the truth. I told you guys about this in my post. This is red pill, blue pill type stuff. If you wanna live in a land of just, hey, everything's great, ignorance is bliss, all those kinds of things, take the blue pill, right? This is not a blue pill presentation. This is a very much red pill presentation. It will unlock the truth and really pull the screen away from, pull back the curtain on the financial industry. So I hope it's informational. I hope it's good for you guys. And again, I'm not giving you guys financial advice. This is just gets the thoughts and the thinking provoked, right? So there's a quote by, hang on, I'm gonna go through some of my notes, by hedge fund manager Peter Lynch, who ran the largest, or like the best performing hedge fund for like, I don't even know, 30 years or something like that, beat the S&P by double. And he's got a quote that says, know what you own and know why you own it. So we're gonna go through exactly what that means with these 5 key considerations. So here's what I'm talking about from the 5 key considerations that we're going to be analyzing. One is individual versus institution. Are your investments individualized for you, or are they institutionalized to fit everybody into a box, right? That's number 1. Number 2 is evidence versus emotion, right? Are you investing based on emotion or actual evidence of how the stock is performing, right? Or how the investment is performing? Are you making decisions that, you know, sell low, buy high, and try to ride the market and ride the waves and all that kind of stuff? Process or product? You know, I'm gonna talk deeper about what that is. Current and history. So, you know, are you looking at current returns and what it's actually producing, or are you going off of historicals, which is what all of these investment advisors say? Oh, you know, historically we've averaged X percentage, right? And then are you looking at your balance? Or are you actually looking at are you looking at the actual balance, or what just the return percentage looks like? And this is like, oh my God, it opened up my eyes so much to this stuff. So first we're gonna talk about individual or institution, right? Is this investment that you're in, is it for Harvard or Howard? Okay, so Harvard, this is an investment fund. Harvard doesn't need cash, right? They don't need cash flow. They're not looking to retire. Harvard needs something where they're investing their money in something where they never need their money back, right? It's for the next 40, 50, 100 years, right? Is what Harvard's investing for. Howard has specific needs. Howard has needs for cash. Howard has needs for cash flow. Howard is an entrepreneur. Howard is a hardworking executive or blue collar employee, white collar. Like, this is anybody that has needs for cash and cash flow on a specific timeline, which is probably every single person on this webinar right now, right? We all have a desire or a need to retire at some point in our life, and we're going to need a certain amount of cash and cash flow from that. So wait until I break down the numbers for you guys on this stuff. Anybody ever seen one of these before? It's the standard investment questionnaire. This takes 6 questions, gives it to every investor across the country, and essentially says, when do you need your money back? You know, how smart are you about investments, and what's your risk tolerance? And it funnels every single investor into one of 6 buckets or 5 buckets, right? Based on what your risk and what your return is. You know, it's institutionalizing individuals. It's really turning us into sheep and herding us into a certain box like cattle. So just like, let me go back, like Howard has very different needs than a Harvard, right? This is based on what Harvard needs, not what Howard or you or me need. So let's talk about evidence or emotion. This is what the market did from October 2002 to October 2007. So had the big, crash before that, and the dot-com burst. But the market over the course of those 5 years, 60 total months, rose by 102%. The average investor was almost back to whole before when the market crashed. So a $241,000 investment grew to $431,000. Why isn't it, if it grew by 102%, why isn't this double? I'm going to go over that in a minute. It's essentially because the market goes up and down, and I'll explain that in a moment. So that was 2002 to 2007. All right, what happened in October 2007? Rut-row, Rorge. The market started declining. And over the course of the next 24 months, less than that, 18 months, 17 months, right? The market lost $11 trillion. And as I was like putting this together, and as I was learning or reading and thinking more about this, like, it says the market lost $11 trillion. I think that's an interesting word, of being lost, because when you say lost to somebody like you and me, it sounds like it's never coming back. It just went up in thin air and it's not there. Does it actually lose though? Is it actually lost, or did somebody else find it, right? I don't know what the answer is. Like, I think it's just interesting that the finance industry says that the market lost money, because I feel like it's a psychological thing to put in our brain, thinking we'll never get that back because it's lost. The money went somewhere. Where'd $11 trillion go? Somebody's hedging, somebody's buying, options and all these different things in order to hedge against that, right? So like the money went somewhere. I just don't know where it went, right? So that's kind of an aside. But over the course of that 17 months, the average investor lost 56% of their portfolio value. Their portfolio went from that $431,000 to $186,000. What if you were going to retire, right? What if you're 58 years old and you're about to retire, and this is what happens to your portfolio? Guess what? You're working for another 25 friggin' years in order to retire again, right? Until you're dead now. So what's important to know here is that there's a cycle of emotions that people go through, right? And they're all excited, they're optimistic about where the market's going, they're enthusiastic, they're exhilarated, they're reached euphoria, they start buying because they're on this upswing, right? Or they're right here, I'm gonna start buying. All of a sudden, the market starts shifting, right? Because some people start selling, and all of a sudden, the values start dropping. Well, it'll come back. Don't worry, I'm in denial, but it'll come back. Well, they told me to just ride it out, right? Now they're pessimistic, but then you start panicking because it keeps on dropping. Oh no, I don't know what I'm going to do. Let me fire sale my stocks. I can't let it go any further. And then you start fire selling, and then other people come in. Somebody comes in and buys that stock at the bottom, and then goes through that entire cycle again. hey, I'm skeptic, but I'm hopeful, right? And then, oh, it's going up. I'm getting a little bit of relief. What happens in a traditional market cycle is people sell when it's high, or I'm sorry, they buy when it's high and they sell when it's low, right? So I'm going to go over a bunch of average returns, because isn't that what a lot of these traditional advisors go through? They go over what like the average returns are over the past 80 years. The S&P has averaged 7% over the past 80 years, and this is what it's averaged. That's cool. That's if you would have stayed in over the course of the average of that 80 years, right? If you didn't tell them to sell off, if you didn't tell them to buy when it was high and sell when it's low, right? This is the years of how this all went too, right? So it follows the graphs that we just went over exactly, right? The cycle of market emotions follows the cycle of returns in the stock market. And I'm gonna actually break away from this real quick. I want you guys to see something here. Let me pull up a calculator. Here's what I mean by if you average, when they say you average 7% a year, I'm gonna get into this in a moment with actual graphs of actual returns over the past 20 years. But let's say you have $1 million in an account. And let's say the stock loses 10%. So I'm going to multiply it by 0.9 because it means it lost 10%. It dropped down to $900,000. If you're going to balance that out, right? Let's say I'm going to balance that out and it's going to go back up 10%. Hey, but it went up by 1.1, right? It went up 10%. I lost 10% one year, but then I gained 10% the next year, so I should be at break even, right? No, you're not. Because the value dropped to $900,000, if it goes back up by 10%, it only grows by $90,000. So although they tell you that your returns are averaging 7%, they're not telling you what's actually happening to your money. They're averaging out the return percentages year over year, not the actual implication that it has to your money. So let me show you this. Let's say it averages 7%. Okay, so I got $1 million in an account. Let's say it drops by, 10% one year, but then it grows by 17% the next year, times 1.17. Boom, $1,053,000. So what if it grew by? It would have to actually grow by 14%. So let's clear it here. $1 million, drops by, let's say 10% the first year, and then it grows by 1.14. That's an average over the course of 2 years of 7% on the return. Why aren't I getting 7%? It should have increased by $70,000, right? And then another should be $140,000, right? It's not making sense. So let me go back to this, and I'm going to show you the actual how that worked out. So now we're going to talk about process or product. So a process is like, I invest in real estate, right? I have a process, a standard value add process that's very predictable for what it looks like, versus what a lot of people do in the stock market. They just go out and buy a product. They buy a mutual fund that's supposed to deliver a certain set of returns, but typically doesn't. So let me show you what one of the products is that came in. I was looking, he didn't tell me who this person was, but I was talking to the financial advisor. He goes, here, this is one of my customers. They came in with a portfolio of $487,000. This portfolio of $487,000 bought certain products, certain hedge funds and certain bond funds that was diversified. I'm using diversified in air quotes right now, into 4,000 different stock holdings and 10,000 different bond holdings. There were over 14,000 different positions or different investments for this portfolio. If you're invested into 14,000 different companies or bonds, how can you possibly know what you're invested in, right? Your financial advisor doesn't even know what you're invested in, right? And this presentation isn't to throw financial advisors under the table because they don't even know most of this stuff, right? They're told what to do by Merrill Lynch and Morgan Stanley and Fidelity and all these different companies on what to do and how to sell their products, but they don't even think, right? They're sheep in this whole process as well, but they don't know what the hell you're investing in, right? Be diversified. Let's see how diversified you really need to get. So we ran a standard deviation of what of how many stocks you really need and bonds you actually need in order to have a diversified portfolio. And what this says is if you have all your money in one stock, you have a little bit more risk, right? 49.24% is the standard deviation on that. Once you get to 30 different stocks, meaning different industries, different companies, different markets, different sectors, different geographies, once you get to 30, you're almost the exact same diversification as if you had 1,000 stocks. Look at the standard deviation is 1 point apart, right? So once you get to 30 truly diversified stocks, you can actually know what 30 stocks are or 30 bonds are, right? It gives you the same diversification as 1,000 or as 14,000 stocks. Pretty similar, pretty close anyways. So current risk, let's talk a little bit about this, and then we're really going to dive into some graphs on what happens to your money. So relying on history. How many times have we seen this quote in red at the bottom? Past performance is no guarantee of future results, right? So that's always a disclaimer at the bottom of everything that we've ever invested in, right? And the reality is, but they try to sell us stocks and they try to sell us different funds based on past performance. So let me show you something that is like mind-boggling. If you look at up here, it says, these are different mutual funds in this category right here. This is the fund count at the start. So this is how many different stocks and stuff were in that fund, or how many funds were in the top quartile of performers, right? So these are top quartile of funds, right? There's 561 top quartile of domestic funds at the start of September of 2014. In just the next 12 months, only 21% of those were still in the top quartile of performers. In the next 2 years, only 4% of those 560 stocks were actually in the top quartile of performers. By year 4, it was less than 2%, less than 1.5%. So this is actually a better chart of it. The top performing investment funds, top 25% of performing investment funds in 2014, there were only 118 of them left in 2015. 20 of them were still in the top quartile, then 9, then 8 over the course of that 5-year period. So when they say that past performance, here's how we've performed in the past, it's not always an indicator of future results, right? This is what happened in the top quartile of performers in 2014 in a growing marketplace, in a growing economy. Although that's how many stocks still fell out. It's insane. So got to be aware of that stuff. They might tell you that, oh yeah, this has been, look at the past performance on this stock, or this fund, it's been amazing. It's in the top 25% and Well, guess what? That doesn't mean it's going to continue to perform that way. So hang on, I'm kind of going through some of my notes and stuff too. This is where it gets good, guys. All right. So now we're going to talk about balances, about what's actually going on in your bank account, what I was kind of showing you on a calculator before, versus the return averages that they're telling you. All right. So here's what it goes. This is the real returns of the stock market over the past 20 years. So this is 2001 or 2000 to 2019 year to date, right? This is what happened to your account balance if you actually had, I don't even want you to look at this column from 7.36 on, only look at this stuff on the left-hand side first. This is the real returns of the S&P 500 in that year, okay? This is what happens to the balance on your bank account if you had $1 million in starting out. First year goes down by 9.11%. You're left at $908,000, $900, right? And then it drops by another 11%. Okay, then you drop down here, drops by another 22%. Things not looking good. But then, boom, things start growing, growth. This is 2008, right? Drops by 37%. And then starts inching back up. And for the past 10 years, we've been in a growth market. Longest growth market we've ever seen, right? This is 2000, last year, remember when the stock market dropped right at Christmas time last year? It actually, we had a loss just because of the dip, but then it jumped right back up the second week in January. So that's what that is. By riding this wave of going up and down, up and down, up and down, up and down. Now they're telling you that the returns average 7.36% per year. If you average up all these returns over the past 20 years, that's what they average. But if you take a look at what it actually did to your bank account did not average 7.36% per year. It rode the wave there, right? So you're at $3 million. If it would have averaged 7.36% per year and you had a fixed predictable return on your investment year after year, then this is how your account would have grown. And by having a steady return, look at this. You have almost $1.1 million more in your bank account, 30% more over that, 35% more in your bank account with a steady return versus riding those waves. So it's actually better to have a lower steady return than it is to ride the stock market up and down cycles. Does that make sense to you guys? You have $1,056,000 more in your account over that same period by having a fixed return versus a volatile return. Think about real estate. Like, I'm a real estate guy. I pay my investors a fixed return every single year. This is like mind-blowing. There's a lot of real estate investors on here who are operators who raise private money. But by taking this information and educating your private money investors who have money in 401ks, who have money in IRAs, and you show them this graph of what's really happening to their money, where they think they're averaging a 7.36%, yeah, do the math. Watch them do the math. Have them pull out their statements. Have them look at what's actually happening to their bank balance, their account balance, with all these different riding of the waves versus they invest with you at the same average return, how much more money they have after 20 years. You think that's powerful? Wait until this. Okay, now this shows the same returns, right, over the course of 20 years. And by the way, there's some people on this who are like, well, it started out with a bunch of loss years. If you look at return 2 column, all I did was I took the same returns in return 1 column and I flipped it all. So the 25% from year 1, if you had 10 years of gains and then a bunch of years of losses, like over here, all I did is I flipped it around. So this is 2019, 2018, 2017, 2016, 2015, 2014, right? And then you start out strong and then you have all these years of losses. You end up with the exact same returns, overall account balance in your account, right? That's all that this says in return 1 and return 2. I hope that makes sense. So what I did is, hey, I'm 34 years old. Let's say I started investing right now and I had $1 million in my bank account, right? For the next 20 years, this is what happens to my $1 million. Ends up being $3 million bucks. Cool. If I rode that wave. Now, what happens if at age 55, 20 years from now, I want to start pulling out $15,000 a month, $180,000 a year from my balance? Okay. Now this is where it does matter if you're having a growth year or a loss year, because look, if you start out with the growth years, again, your account balance grows quite a bit and you can still take out $180,000 a year and your account will continue to grow. And by the time you're 74, 75 years old, your account's still worth more than what it was, right? But if you start out with a loss year, What if all of a sudden somebody retires this year, and are we at the top of a market or the bottom of a market? We've had 10 years of a bull run, right? So is it more likely that that will continue, or that the cycle will set in, right? And we're going to have some down years. If we have a few down years and you're still taking money out of your account, look at how this adversely affects your account balance. And by the time you're 71 years old, you run out of friggin' money. You're going back to work. You're a greeter at Walmart, right? So I hope that makes sense to you guys. Let me go over it one more time. You're setting your money, set it and forget it for 20 years. Doesn't matter if the account's up, starts out strong or weak. After 20 years, you're right here. The returns average 7.36%. Your bank account, or your account balance did not average that as if it was a steady return. I'm just giving you the stock market return, right? And then over here on the right-hand side, again, this is assuming that you're taking out $180,000 a year for retirement, 15 grand a month, which who wants to live off of 15 grand a month, right? No, I'm just kidding. But the reality is, if you have good years starting out, that's okay. That will affect in a good way your account balance, right? If you have some bad years coming over the next 3, 4, 5 years, you're screwed. Your account balance gets hit so hard that you cannot recover from it. So this is important to understand for people who are retiring, who have retirement accounts they're not far out. Maybe they're over the next 3, 4, 5 years. Guess what? All of a sudden they have a few years of losses. These people are going back to work by the time they're 65, 70 years old. They're going to run out of money. So it's important for them to understand and look at, it's the same 7.36% average return on their money. It's so much better to have a steady return of 7.36 than it is to have, this is the last one. This is the steady return of 7.36. So after your 20 years of letting it grow, boom, and this is assuming it's in the stock market. Let's say they pull it out, and for retirement, they put it in a fixed asset. They lend it to you in real estate, right? They lend it to me backed by commercial real estate that they're earning a fixed return, predictable 7.36% every year. Look at, they take out $180,000 every year, and their account still grows more than when it started out with a bull market for 10 years, right? 4.48, 4.49. You're actually ahead even with by having a lesser, more fixed return than having a bull market of 20%, 18%, 22% returns over the first 10 years, right? And then it averaging out to 7.36%. This is the power in paying somebody. If you're a private, or if let's say you're an active operator and you're borrowing private money, this is the power in paying somebody a fixed return on their investment, a predictable return on their investment, where they're not riding the market cycle, where they're not riding those waves, right? This is the kind of stuff that your stockbroker, your financial advisor does not tell you, right? It's all based on past performance, right? Except for the disclosures and disclaimers at the bottom of the investment page. So this is if you don't ride an emotional wave also, right? If you're riding an emotional wave and you're telling your financial advisor to pull out right at the bottom and buy in at the top, like the actual average investor, there's market data on this, earns a 3%, not a 7.36. I gave you 7.36 because this is the S&P's average over the past 20 years. The average investor, if you take a look at their actual average returns in their portfolio, is less than 3%, because they jump out and they jump in based on emotions. Now, disclaimer, there's a lot of people that have done much better than that. I'm talking about the average investor there, right? So this is just to show you that a steady return yields far more than riding that wave, right? It's the same percentage that's told to you, but very, very different in actual cash value, right? So I'm not even talking about the impact of fees, right? Now let's go into that. Let's talk about the fees that your financial advisor charges. That $3.1 million account balance, if you let it ride for 20 years, That's assuming there's no fees added in. The average industry fee, or the industry average fee, is 1.75% across all accounts. 1.75%. That ranges, the people who have small accounts, small balances, pay more, a higher percentage in fees. They might pay 2% versus the larger account balances that might be at 0.5% or 1%, right? I'm talking about the fee that you actually see on your statement. I'll talk about the fees that are not reported on your statement in a moment. But look at how these fees adversely affect. So if there's no fees over that 20-year period, boom, you're at the 3.1 million that we talked about, right? All of a sudden, you add in just a 0.5% fee per year. All of a sudden, your return, your account balance drops by $287,000. If there's a 1% fee, it drops by $550,000. There's a 2% fee, you have $1 million less in your account balance. That's the impact of the fees that they don't tell you about. What is it good doing to your? So again, a lot of people on this are active operators. What if you went out and you educated your passive lenders that this is what's happening to their account balance every time they take 1%, or the broker or their financial advisor takes 1% off the top? I'm not even, this is the fees that they know about. I'm not telling you about the other fees. So, and like me, I pay my investors, let's say 10%. If I'm paying them, I'm not taking 1% off of a fund administration fee, right? They're getting all of that money. They get the blue line up at the top, right? I'm not taking a 1 or 2% fee on that. You got to be aware of this kind of stuff. If you're investing in even like a traditional investment fund, right? You're investing in a traditional, like not even in the stock market, even these real estate funds, right? A lot of times they're charging fees that drops your return over the life of your investment. That significantly adversely affects the life of your investment too. So that's the fees that you guys know about. Let's talk about the ones that you don't know about. What the hell are all these? Transaction fee, expense ratio, estimated tax liability, total annual cost. What does all that mean, right? So these are the highest, or like I think they're the 5 largest investment funds in the nation right now. So Fidelity, Contra Fund, Vanguard, Wellington Fund, Growth Fund of America, Income Fund of America, Dodge & Cox Stock Fund. Okay, great. These are the big, if you have money in the stock market, you have money in mutual funds, chances are they're in one of these funds, right? These are the fees that they do not tell you about right here. Transaction fee and expense ratio fee. This is the hidden cost that nobody talks about. These are taken off the top of your return. You don't see it on your statement because it's taken off before that. But if you read the prospectus to see what these fees are, which nobody does, right? It's a 100-some page document or whatever. But go into your prospectus and look at what these fees are. Look up the transaction fee, look up the expense ratio, right? They take this off of the top of your return. So although they say it's 7.3%, really on your statement it shows whatever, 6%, right? Because they take these off of the top. So it never really even shows up on your statement because you probably get really, really pissed if you did. These are hidden costs that nobody knows about, right? It erodes your return significantly. Here's what the expense ratio and the transaction fee, these are the fees that the mutual fund companies take to essentially make trades. It's their overhead, right? To make trades, to run reports, to run and operate the fund all together. This is what they're taking off the top, in addition to the 1.75% average that they're paying out your financial advisor. Estimated tax liability. What the hell is this? You know what this is? This is the whenever a mutual fund makes a trade, they pass on 100% of the tax liability to the people who are invested in that fund. What that means is if they bought a stock, right, I don't know, 15 years ago, you're not even in the fund. You just bought the fund this year. They bought the stock, some stock 15 years ago at $50 a share, and they sell it today for $2,000 a share. There's $1,950 per share of taxable long-term capital gains or whatever the tax rate is on that they pass on to the current holders of that stock or of that mutual fund. So they take that off the top. The fund managers aren't taking that. I was just on a yacht last week down in the Virgin Islands. You know who owned all the friggin' mega yachts that were next to mine? The one that I rented? I rented a dinky 116 foot. They're not even allowed to call it a yacht. It's called a boat, I think. Or yeah, I think they just call it a boat. The mega yachts start at 150 feet. Some of these were $200 million mega yachts. You know what they were all owned by? Fund managers. Why? Because they don't pay the taxes on the sales of the stocks and the mutual funds. They pass it 100% on to you and me as the people who own the mutual funds. So we're paying for the tax liability on stocks and trades that they're making today from stuff that they bought a long time ago. And that's getting passed along to us. Read the prospectus. It's all in there, right? These average out to be, a couple of these were like performed really, really well. So the adverse effect on your return wasn't that big of a deal, but on some of them, it was up to another 4%. To like it averages out to be about 4% overall on the loss of your value between the 1.75 plus this stuff. If you add it all up, so it's 1.26%, 2.9%, 0.5%, 2.6%. This one's only 1/100th of a percent, right? But if you add 1.75 onto this, it's eroding about 4% from your somewhere between 2 to 4% from your overall returns. So you think about that, and you think about you were averaging 7.3% before, and what? Let me just show you this one again. What 1% or 2% or 3%, or I'm sorry, 1% or 2% does to your stock portfolio. Imagine 4%, and how much that adversely affects your returns and your account balance, right? So again, it's ammunition to go and talk to your private money lenders and to let them know about how this is adversely affecting their account balance for retirement versus investing with you with a fixed return of 8% or 7% or 5% even, or 12%, right? Without fees being taken out, backed by a hard asset, right? Something that you actually have some control over versus, Tesla stock, where the CEO jumps on an interview and smokes a joint on live television and the stock drops by 15% the next day, right? Or Volkswagen cheating emissions tests, and all of a sudden that news comes out, something we have no control over, and the stock value drops significantly, right? What if there's a hashtag Me Too movement at some C-level executive at a Fortune 500 company that you own a bunch of stock in, and all of a sudden that stock drops, right? Because they have to clean house and they're worried about the future of the company, right? Like, this is all stuff that's outside of our control, investing in mutual funds and investing in traditional markets, right? So this just says, what would Howard do? So I hope this opened up your guys' eyes on some stuff. But what I wanted to do is just kind of put this out there. I want to get your brain rolling, right? Now, what do you do? What do you take this information? What are you going to do with the information? These are questions that I ask myself. Like, what do I own, right? What do I own? Do I even know what I own? No, I don't. I know that I give money in my IRA and my 401k and my kid's 529 plan, and I know I give that to my financial advisor, but do I know what they put it in? No, I have no friggin' idea. And even if I knew what the mutual fund was, do I know what the mutual fund owns? No, I have no idea, right? I need to understand that. And I would highly suggest you understand that, and you educate your private lenders on figuring out what they own too. Two, why do you own it, right? Why do I own that versus something else, right? Is it because its past performance has been good? Past performance is not always an indicator of future performance, right? So is it because they told me? Is it because they're making a bigger fee on it, the financial advisor? Is it because they take a larger percentage on it, right? So think about that, right? Another question I'm asking myself, or you should be asking yourself, why are you investing? I mean, for me, and I think it would be for most people on this, it would be, to one day buy back your time, right? Have enough passive income that exceeds your monthly expenses, where now you are financially free and you can go and do whatever you want, whenever you want, wherever you want, with whoever you want to do it with, right? Buy back your time, be able to retire, travel, spend time with kids, give back, whatever that looks like. How do we create that? Typically, the answer is cash flow, right? Residual income, passive income. Is investing in the stock market, is investing in mutual funds, is investing in those things produce that for you? I don't know. Yes or no, maybe. Depends on you and your risk. I mean, I can't answer that for you. For me, I can tell you it's not. For me, I want fixed returns. I want predictable returns, and I want them backed by a hard asset, especially when I'm at the peak of a market. Just some things to consider. Like, if you guys are not like for me, I reached out to my financial advisor. I'm not telling you guys that you need to do this. I'm not telling you what to do, but I'll tell you what I'm doing is I reached out to my financial advisor. I said, listen, man, at least for the next 6 months, I want my money in only assets, my 401k, my IRA, my 529, my kids 529, all those different things. I want it only in assets that cannot lose any principal. I don't give a shit if you go and deploy it into a certificate of deposit at one of the banks that yields me 0.5% a year, because what I don't want to do is lose my principal value. It's not necessarily about return on investment. It's about return of investment. I want my money, right? I never, ever, ever want to risk my principal. And that's why I'm taking my money out. I'm putting it in fixed things. And that's why I only buy real estate. So I'm not saying that that's what you guys need to do, but if you are looking for other stuff, there's a lot of people out there. Just post on social media, reach out to anybody about, hey, what are some real estate assets that I can invest in? What are some things that I can deploy my capital in that pays me a fixed return, that doesn't get feed to death, right? That's backed by a hard asset, that has predictability to it, right? There's a lot of that stuff that's out there. So anyways, I got this hammered out in about 45, 50 minutes for you guys. I hope that was super helpful. I hope it just at least get your wheels turning. I hope you make some good decisions. I hope you sit back and reflect over the holidays and over the new year. And I know we all want to make more money and lose weight, right? And so hopefully you keep your money as well. And I hope you guys ask yourself some really good questions, and that leads to really good answers on what to do with your money, how you're investing, why you're investing, what you're investing in, and all those different types of things. So if there's ever anything that I can do for you guys, or if anybody wants some of these graphs, shoot me a message, and I'm happy to share it with you guys, so that way you can have some of this information as ammo and kind of really reflect on it and dissect it. So other than that, hey, I love you guys, and if there's ever anything that I can do, please reach out and connect with me. I love matching up and connecting with people and meeting great people who are on a similar trajectory in life, and going in a positive direction and doing progressive things that impact the world in a positive way. So appreciate you guys. Take this information and digest it, think on it, sleep on it, and pray on it probably. And I'll see you guys.